The Australian share market is set for another negative start following weak overseas leads, but oil majors could provide some relief to stem the losses. Let's go to Peter Switzer, founder of the Switzer Report. Pete, it's been rough viewing for a while now if you're in the market, so it could be another, at least there, like we said, rocky start to the week. How's it going to proceed from there?
Yeah, and that's despite the fact that the US had a pretty good jobs number over the weekend. Pete, look, I think the bottom line is we're in a volatility trap for at least the next 2 months or so until a lot of things get sorted out. And that is like, how fast will central banks be raising interest rates? And how big will those interest rate rises be? You know, even just locally, Pete, we've got Goldman Sachs tipping that the cash rate could be 2.6% by the year's end. And that'd be what? We're at 0.35 now. So it's going to be like a 2.25% increase in the cash rate by the end of this year. If that's the case, well, we're talking recession. You know, the Australian economy won't be able to take that. And the same kind of analysis is happening in the US as well. If the Fed raises interest rates too hard and too fast, they'll be looking at a recession as well. And I don't think the central banks will make mistakes of that magnitude, but it's out there right now, and it's a battle, and it's playing out on the stock market.
Yeah, one of many people I spoke to last week about this was Bill Evans, and he mentioned it won't get that high. That's in his view. He says it'll probably top out at 2.15 towards the middle of next year. Where do you think it'll top out at?
Yeah, I wouldn't be surprised if we got to 2 over maybe a slightly longer period of time than is currently being mentioned. I don't think there's going to be a race to raise interest rates quickly if two things happen. One is that Ukraine gets eventually settled. Now, let's just imagine it takes another 6 months before some kind of peace breaks out in the Ukraine. Well, the oil prices would fall instantaneously. Be a great confidence booster for stocks and for businesses that are sensitive to the price of oil. And I also think you've got to think about China's not going to be in lockdown for 6 months. Surely China will eventually get on top of its pandemic problems, and then more stuff will come out of their factories to lower the supply chain costs. So all that will work, I think, in favour of a much lower cash rate in the time frame that many economists are talking about right now.
And house prices could fall. That's the expectations anyway, about 25%. That's the lowest level since April 2020. Pete, do you think this will mean house prices will correct or level out?
Yeah, I think the 25% call comes from Chris Straw, and Chris is actually a pretty good predictor. Has leaned against a lot of the doomsday merchants in the past, but he still makes a point that if you look at where house prices started nationally, they were about what? They're up about 40-odd% or something like that. Sydney about 50%. You take 25% off, you've still got a reasonable rise over a period of time of 2 or 3 years. But the thing is this, it's a guess. It's his best guess. It could be less. Some suburbs will definitely fall by 25%, I reckon, if interest rates go up the way economists are predicting. But if the rise in interest rates is slower, central banks can control it and the inflation could come down. Well, that pullback in house prices might only be 15%.
Okay. Peter Switzer, thank you. We'll talk to you soon. Have a good week.